Alright, before we get into the secret sauce of buying your first home, we have to do the responsible thing. Please remember, this presentation is for educational purposes only. I'm here to share my research and experience, but I am not your financial advisor, your mortgage broker, or your real estate agent. The world of lending changes fast, so please, always consult with licensed professionals to get advice tailored specifically to your situation. Think of me as your guide, but they're your official pit crew. Okay, legal stuff out of the way, let's get you those keys. Picture this for a second. You've spent the last 6 months glued to your phone, scrolling through Zillow and Redfin until your thumb is numb. You've favorited dozens of homes. You've imagined where your couch would go, what color you'd paint the bedroom, hosting your first barbecue in that perfect backyard. You've done the drive-by. You've found it. The one. Your heart is pounding. This is it. This is the start of your new life. And then you talk to a lender. Suddenly, this exciting dream morphs into a nightmare of paperwork and confusion. They start throwing around acronyms like they're speaking a different language. FHA, USDA, DTI, LTV, PMI, ARM. Your eyes glaze over. They ask about your credit score, your savings, your work history. Every question feels like a test you didn't study for. And that dream, that beautiful picture of your future home, starts to feel like it's slipping through your fingers. You walk away feeling defeated, overwhelmed, and convinced that homeownership is a private club you just don't have the password for. If that sounds even remotely familiar, I need you to take a deep breath. You are in exactly the right place. That feeling of confusion and anxiety is precisely what stops millions of Americans from ever buying their first home. Or worse, it pushes them into a terrible loan that costs them tens of thousands of dollars down the road. But that is not going to be you. Not after watching this video. My promise to you is simple. Over the next 20 minutes, we are going to completely demystify the 5 best home loans for first-time buyers in the United States for 2026. We are going to turn that confusion into confidence. We're not just going to list them off. For each loan, we're going to break down exactly who it's for, the hidden advantages that can save you a fortune, and the critical traps you absolutely must avoid. By the end of this guide, you will have a crystal clear roadmap. You will be able to walk into any lender's office, look them in the eye, and know exactly which loan is the right tool to build your future, not just a financial trap to fall into. First, we have to dismantle the biggest, most destructive myth in real estate. It's a myth so powerful it has probably stopped you or someone you know from even trying to buy a home. And that myth is, you need to have a 20% down payment to buy a house. Let me say this as clearly as I can. That is a lie. It is outdated old-school advice that simply does not apply to the vast majority of first-time buyers today. Is putting 20% down a good idea if you have the cash? Absolutely. It helps you avoid a nasty little thing called private mortgage insurance, or PMI, which we will talk about later. It lowers your monthly payment and it gives you instant equity. But is it required? Not even close. The reality is, the average down payment for first-time buyers is closer to 6%. And the loans we're about to cover? They allow you to get into a home for even less. We're talking 3.5% down. 3% down, and in some incredible cases with one of the loans we'll discuss, you can buy a home with zero. That's right, $0 down. So if you've been sitting on the sidelines trying to scrape together $40,000, $50,000, $60,000 in cash while watching home prices climb higher and higher, I want you to let go of that belief. The 20% rule is a gatekeeper that has been keeping people like you out of the game for far too long. The real key isn't having a mountain of cash. The key is knowledge. It's understanding the system and knowing which specific loan program was designed to help someone in your exact situation. And that's our mission today. We are going to be your strategic guide through this financial maze. We're going to break down the top 5 loans, and we're going to do it in a way that actually makes sense. For each of the 5, we'll look at it through 3 critical lenses. Number 1, the ideal candidate. Who is this loan perfect for? Is it for someone with a lower credit score? Someone with very little saved for a down payment? Someone buying in a rural area? We'll paint a clear picture so you can see if you fit the profile. Number 2, the superpowers. What are the incredible, game-changing benefits of this loan? This is the good stuff, the low down payments, the flexible credit requirements, the potential for seller concessions that can save you thousands at the closing table. And number 3, the kryptonite. Every loan has a weakness, a hidden danger, or a costly drawback that you need to be aware of. This could be a specific type of insurance that sticks with you for life, or limitations on the type of property you can buy. Ignoring the kryptonite is how people end up with a loan they regret for decades. We will shine a bright light on these pitfalls so you can avoid them. By looking at each loan through this framework, candidate, superpowers, and kryptonite, you'll be able to compare them side by side and clearly see which one aligns with your financial DNA. We're going from a confusing mess of options to a simple strategic choice. And make sure you stick around for loan number 5. It's a bit of a hidden gem that most first-time buyers, and even some lenders, don't talk about nearly enough. It combines some of the best features of the other loans and could be the perfect fit if you meet its unique criteria. Look, choosing the right home loan is the single most important financial decision you will make in your 20s or 30s. This isn't like picking the wrong cell phone plan. Choosing the wrong mortgage can literally cost you over $100,000 in extra interest and fees over the life of the loan. It's the difference between your home being a springboard for wealth creation or a financial anchor that weighs you down for 30 years. The information we're about to cover is the foundation of that decision. It's the cheat code. So, if you're serious about not just buying a house but buying it the smart way, then give this video your full attention. The next few minutes are designed to save you stress, save you time, and most importantly, save you a massive amount of money. We're going to kick things off with the undisputed champion for many first-time buyers. It's a loan that's famous for its low down payment and its forgiving credit requirements. It has opened the door to homeownership for millions of Americans who thought that door was permanently locked. Let's dive straight into our number 1 loan, the FHA loan. Now, FHA stands for the Federal Housing Administration, and here's the first thing you absolutely need to understand. The FHA doesn't actually lend you any money. They're not a bank. Think of them as a giant insurance company for your mortgage lender. They tell your bank, hey, if you give a loan to this person and they can't pay it back for some reason, we've got your back. We'll cover your losses. This insurance is what gives lenders the confidence to approve loans for people who might not fit the perfect, cookie-cutter mold that traditional banks often look for. It's a government-backed program designed from the ground up to make homeownership accessible. So let's break down the magic of the FHA loan, starting with the number 1 reason it's so popular: the incredibly low down payment. With a conventional loan, you've probably heard you need to save up 20% of the home's price. On a $300,000 home, that's $60,000 in cash. For most people, especially first-time buyers, that is a mountain of money that could take a decade to save. The FHA loan completely changes the game. It allows you to put down as little as 3.5%. Let's do the math on that same $300,000 house. 3.5% is just $10,500. That's a massive, life-changing difference. Suddenly, the dream of owning a home moves from a distant someday to a very real, maybe next year. This single feature is the primary reason the FHA loan has been a gateway to the middle class for generations. The second huge advantage is the flexible credit score requirement. This is where the FHA really shines for people who are still building their credit history or maybe hit a rough patch in the past. To qualify for that 3.5% down payment, you generally need a minimum credit score of just 580. For comparison, many conventional loans want to see scores in the high 600s or even over 700 to get the best rates. An FHA loan gives you a lot more breathing room. And get this, the FHA program can go even lower. If your credit score is between 500 and 579, you might still be able to get an FHA loan, but you'll be required to put down 10% instead of 3.5%. It's a higher bar, but for someone with a damaged credit score, it's a potential path forward that simply doesn't exist in the conventional loan world. Next up is something called your debt-to-income ratio, or DTI. Sounds complicated, but it's really simple. Imagine your monthly income is a bucket of water. Every bill you have, your car payment, your student loans, your credit card bills, is a small hole in that bucket. Your DTI is just a measure of how much water is leaking out each month compared to how much you put in. Lenders use this to make sure you have enough water left in your bucket to afford your new mortgage payment. Conventional loans are often very strict about this. They don't want to see too many holes in your bucket, but FHA guidelines are more generous. They typically allow for a higher DTI, meaning they understand you might have student debt or a car loan, and they're more willing to trust that you can manage your finances and still afford a house. For millions of Americans juggling these existing debts, this flexibility is the key that unlocks the door. And what if you're struggling to even save that 3.5%? The FHA has another incredible feature. It's very friendly to gift funds. This means your parents, your grandparents, or another close relative can give you the money for your entire down payment. There's no requirement that you have to save it all yourself. You just need a signed gift letter from the donor stating that the money is a true gift and not a loan that needs to be repaid. This is a huge help for young buyers who have the income to support a mortgage payment but haven't had the years to build up a large savings account. But of course, there's no such thing as a free lunch. The FHA loan has some significant trade-offs, and the biggest one, the one you absolutely need to understand, is called mortgage insurance premium, or MIP. Remember how the FHA insures the loan for the lender? Well, you're the one who pays for that insurance. And you pay for it in two ways. First, there's an upfront mortgage insurance premium. This is a one-time fee, currently 1.75% of your total loan amount. That's usually rolled into your mortgage so you don't pay it out of pocket. On a $300,000 loan, that's an extra $5,250 added to your balance. But the real kicker is the second part, the annual mortgage insurance premium. Despite its name, it's not paid once a year. It's broken up and added to your mortgage payment every single month. This can add $100, $200, or even more dollars to your monthly bill. And here is the most critical part. If you put down less than 10%, which most FHA borrowers do, you will pay this monthly mortgage insurance for the entire life of the loan, 30 years. It never goes away unless you sell the house or refinance into a different type of loan. This is a fundamental difference from conventional loans, where private mortgage insurance, or PMI, automatically drops off once you reach about 22% equity in your home. With an FHA loan, you're paying that extra fee for decades, and it can add up to tens of thousands of extra dollars over time. This is the price you pay for the low down payment and flexible credit requirements. Another thing to be aware of is the FHA property requirements. Because the government is insuring your loan, they want to make sure the house you're buying is safe, sound, and secure. This means the home has to pass an FHA appraisal, which is more stringent than a standard appraisal. The appraiser will look for any issues that could affect the home's safety or livability. Things like peeling paint in a home built before 1978, which could be a lead paint hazard, or a roof that's near the end of its life, or a broken furnace. If the appraiser finds these problems, they must be fixed before the loan can close. This is great because it protects you from buying a lemon, but it can also be a deal killer in a competitive market. Some sellers, especially those selling as is, might not be willing to make those repairs and will choose an offer from a buyer with a conventional loan instead. Finally, FHA loans have limits. You can't just go out and buy a $1 million mansion with an FHA loan. The government sets maximum loan amounts that vary by county across the United States. In most parts of the country, the limit is more than enough for a modest first home. But if you live in a very expensive area like San Francisco or New York City, the FHA loan limit might not be high enough to buy the kind of home you're looking for. You can easily find the FHA loan limits for your specific county with a quick online search. So, who is the FHA loan perfect for? It's for the person with a steady job and a reliable income, but who hasn't had the time to save up a 20% down payment. It's for the recent college graduate with student loans but a good starting salary. It's for the young family whose credit score took a hit a few years ago, but has been responsible ever since. It's for anyone who thought homeownership was out of reach because they didn't have a perfect financial history or a huge pile of cash in the bank. And who should probably avoid it? If you have a great credit score, say 740 or higher, and you have managed to save a down payment of 10%, 15%, or even 20%, you will almost certainly get a better deal with a conventional loan. You'll avoid the lifetime MIP payment and potentially get a lower interest rate, saving you a fortune in the long run. The FHA loan is a powerful tool. It's not a handout. You still have to prove you can afford the monthly payments. But it is a hand up. It's a program that levels the playing field and turns the American dream of homeownership into a reality for people who are willing to work for it. But it's just one of the 5 major options available to you. Next, we're going to look at a loan designed for a very specific group of heroes, a loan with what is arguably the single greatest benefit in the entire mortgage world, a true 0% down payment. That promise, that incredible benefit, comes from a loan program that isn't just a financial product. It's a thank you note written into federal law. This is the VA loan, and it is, without a doubt, one of the most powerful homeownership tools ever created. It's backed by the U.S. Department of Veterans Affairs, and its entire purpose is to help those who have served our country achieve the American dream of owning a home. So, who gets access to this incredible program? Eligibility is the first and most important gatekeeper. This loan is specifically for active duty service members, veterans, and in some cases surviving spouses. Let's break that down because the details matter. For active duty members, You generally become eligible after serving for 90 continuous days. For veterans, the requirements depend on when you served. If you served during wartime, you typically need 90 days of active service. If you served during peacetime, it's usually 181 days. And for those who are members of the National Guard or Reserves, you'll generally need 6 years of honorable service. Now, if you were discharged for a service-connected disability, those time requirements often don't apply. And finally, and this is so important, the program also extends to certain surviving spouses of service members who died in the line of duty or as a result of a service-related disability. Now, that might sound like a lot of different categories, and you might be wondering, how do I prove I'm one of them? The answer is a document called the Certificate of Eligibility, or COE. Think of this as your golden ticket. It's the official proof from the VA that you meet the minimum service requirements and are entitled to the loan benefit. In the past, getting this document could be a bit of a process, but today, it's incredibly streamlined. In fact, most VA-approved lenders can get your COE for you online in a matter of minutes, using just a few pieces of information. So don't let the idea of government paperwork intimidate you. This is one step that has become remarkably simple. Once you have that COE, you unlock the program's 3 superpower benefits. The first, and the one that gets all the headlines, is the 100% true $0 down payment. Let's put that into perspective. We just talked about the FHA loan, which requires a minimum of 3.5% down. On a $400,000 home, that's $14,000 cash you need to bring to the table. With a conventional loan, even a low down payment option at 3%, you'd still need $12,000. With a VA loan, the minimum down payment is 0. That's not a typo. You can finance the entire purchase price of the home. This single benefit catapults people into homeownership years before they would have otherwise been able to save up that massive chunk of cash. It is, for many, the difference between buying a home and renting for another decade. But here's the secret that makes the VA loan even more incredible. It's the second superpower. No monthly private mortgage insurance, or PMI. This is huge. Let me explain. On almost any other loan, if you put down less than 20%, the lender sees you as a higher risk. To protect themselves, they force you to pay an extra insurance premium every single month. That insurance doesn't protect you. It protects them. And it can add hundreds of dollars to your monthly payment. On that same $400,000 home with a low down payment, you could easily be paying an extra $200 a month in PMI. That's $2,400 a year just gone. With a VA loan, there is no PMI. Ever. The government's guarantee on the loan takes the place of that insurance. So not only do you get into the home with 0 down, but your monthly payment is significantly lower from day one, for the life of the loan, compared to other low down payment options. Combining 0 down with no PMI is a 1-2 punch that makes homeownership radically more accessible and affordable. Now you might be thinking, this sounds too good to be true. What's the catch? And you're right to be skeptical. There is a cost associated with the VA loan, but it works very differently from PMI. It's called the VA funding fee. This is a one-time fee paid to the VA to help keep the program running for future generations of service members, ensuring it doesn't cost the taxpayers a dime. The fee is a percentage of the loan amount, and it varies based on your service, your down payment amount, and whether it's your first time using the benefit. For most first-time users putting 0 down, it's typically 2.3% of the loan amount. Now that might sound like a lot, but here's the key: you don't have to pay it out of pocket. Almost every borrower chooses to roll the funding fee right into their total loan balance. So while it does increase your total loan amount slightly, it doesn't require any cash at closing. And here's an absolutely critical exception. Veterans who receive VA disability compensation are completely exempt from paying the funding fee. For them, the loan is truly 0 down with no PMI and no funding fee. It is an unmatched benefit. The third superpower is that VA loans often come with some of the most competitive interest rates on the market. Because lenders know that the VA guarantees a portion of the loan if you default, they see it as a very safe bet. Less risk for them means a lower interest rate for you, which saves you tens of thousands of dollars over the life of the loan. On top of that, the VA limits the closing costs that lenders are allowed to charge, protecting you from junk fees and keeping your out-of-pocket expenses as low as possible. So, are there any downsides? It's less about downsides and more about understanding the rules of the road. First, the property you're buying has to meet what the VA calls minimum property requirements, or MPRs. The VA wants to ensure our veterans are buying homes that are safe, sound, and sanitary. This means the home has to be in generally good condition. It's not the best loan for buying a major fixer-upper that needs a ton of work right away. But honestly, for a first-time buyer, this is more of a protection than a hindrance. It ensures you're not buying a money pit. The second rule is that you must intend to occupy the home as your primary residence. This program is designed for homeownership, not for building a portfolio of rental properties right out of the gate. So let's recap the VA loan. You have the potential for a true 0% down payment, saving you over $10,000 in upfront cash. You have no monthly PMI, saving you hundreds of dollars every single month. You get some of the most competitive interest rates available, and you have built-in protections against junk fees and buying a home in poor condition. It is an A+ top-tier loan program. If you have served in the United States military or are the eligible surviving spouse of someone who did, this should be the very first loan you investigate. It is a benefit you have profoundly earned. But what if you haven't served in the military? What if you don't have access to this incredible program? Don't worry. The next loan on our list is designed for people in a completely different part of the country, and it shares the VA loan's most powerful feature, that magical 0% down payment. But it's for civilians, and it's focused on a specific type of community you might not expect. I'm talking about the USDA Rural Development Loan. And before you click away thinking, "I'm not a farmer, I don't want to live in the middle of a cornfield," you need to hear this. This is single-handedly the most misunderstood and underutilized home loan in America, and for thousands of first-time buyers, it is a literal cheat code to homeownership. The United States Department of Agriculture, the USDA, isn't just about food and farming. They have a mission to help develop communities outside of major metropolitan centers. To do that, they created a home loan program that is so good it almost sounds fake. Like the VA loan, it offers a 100% financing option. That means $0 for a down payment. Let me say that again. A zero-down home loan, available to the general public, not just veterans. So what's the catch? Well, there are two main requirements, and they're probably not what you think. The first and most important is location. The property you buy must be in a USDA-eligible area. And here is the secret that most people miss. The USDA's definition of rural is incredibly broad. We're not talking about places with no stoplights and more cows than people. We're talking about huge swaths of suburban and exurban America. We're talking about charming small towns with vibrant main streets, quiet suburban neighborhoods with great schools, and communities just a 30 or 40-minute drive from a major city center. Think about the map of the United States. Now picture all the major cities: New York, LA, Chicago, Houston. Shade those in. Now shade in the dense, inner-ring suburbs immediately surrounding them. Almost everything else, that vast majority of the country's landmass, has the potential to be USDA eligible. In fact, 97% of the geographical United States is in a USDA eligible zone. This is a game changer. You might be renting an apartment in a city, thinking you're completely priced out, when a beautiful home with a backyard in a town just 25 miles away is eligible for a zero-down payment loan you never even knew you qualified for. So how do you check? This is crucial. Don't just guess. The USDA has a very simple, official eligibility map on their website. You can literally type in an address of a home you find on Zillow or Redfin, and the site will tell you in 2 seconds, eligible or not eligible. I highly recommend you pause and bookmark that site right now. It could literally change the entire scope of your home search. It opens up a world of possibilities. The second major requirement is income. This loan is designed to help low to moderate income families. So there are income limits. But again, just like their definition of rural, their definition of low to moderate income is probably a lot higher than you imagine. These limits vary wildly by county and by the number of people in your household. For example, in a certain county in California, a family of 4 could make up to $150,000 a year and still qualify. In a more affordable part of Texas, that same family's limit might be closer to $110,000. The point is, don't assume you make too much money. You have to check. Just like the property map, the USDA has an income eligibility tool on their website. You plug in your state, your county, and your household details, and it tells you the exact income limit for your area. Between these two online tools, you can know within 5 minutes if the USDA loan is a potential pathway for you. So let's recap the power here. We have a zero-down loan. We have eligibility in tons of desirable suburban towns and communities. And we have reasonable income limits that cover a huge portion of working American families. But it actually gets even better. Remember how we talked about mortgage insurance? That extra fee you pay when you put down less than 20%? The FHA has it, and it's pretty expensive. The USDA loan also has a form of mortgage insurance, but they call it a guarantee fee. And it is significantly cheaper than the FHA's. It's broken into two parts just like the FHA loan. First, there's an upfront fee. As of right now, it's 1% of the loan amount. So on a $300,000 loan, that's a $3,000 fee. Now you're thinking, wait, you said zero down, but now there's a $3,000 fee? Here's the key. The USDA allows you to roll that fee directly into your total loan balance. So you don't have to pay it out of pocket at closing. Your loan amount just becomes $303,000 instead. Then there's the annual fee, which is broken up and paid monthly in your mortgage payment. For a USDA loan, that annual fee is currently just 0.35% of the loan balance. Let's compare that to the FHA loan we just talked about. The FHA's annual mortgage insurance premium is typically around 0.55%. That might not sound like a huge difference, but on that same $300,000 loan, the USDA's monthly mortgage insurance would be about $87. The FHA's would be about $137. That's $50 a month every single month that stays in your pocket. That's $600 a year. Over the first 10 years of the loan, that's $6,000 in savings just on mortgage insurance alone, all while getting into the house with zero money down. So, who is this loan absolutely perfect for? It's for the first-time buyer who feels trapped by rising home prices in the city. It's for the young couple that wants a yard for their dog or a safe street for their kids to play on. It's for the remote worker who no longer needs to live 10 minutes from the office and wants more house for their money. It's for anyone who has good credit. Lenders typically look for a score of 640 or higher, and a steady income that falls within the local limits, but who just hasn't been able to save up that massive pile of cash for a down payment. Of course, no loan is perfect. The main drawback is the geographic limitation. If you absolutely must live in the heart of downtown San Francisco or midtown Manhattan, this loan won't work for you. And the income cap means it's not for high earners. But for millions of Americans, this loan strikes the perfect balance, offering a path to a home with more space and a better quality of life, without the impossible hurdle of a down payment. It is America's best-kept home buying secret. Now we've covered 3 incredible government-backed loans: the flexible FHA, the unbeatable VA loan for veterans, and the powerful zero-down USDA loan for rural and suburban areas. They are all fantastic tools for getting your foot in the door of homeownership. But what if you don't qualify for them? What if your income is too high for a USDA loan? What if the condo you want isn't FHA approved? Or what if you just want to avoid the specific rules and property standards that can come with government loans? That's when you step into the world of conventional lending. This is the loan that most people think of when they hear the words home mortgage. And it's the one surrounded by the biggest, most destructive myth of all: the myth of the 20% down payment. That single belief has stopped more people from becoming homeowners than any other. It is fundamentally wrong. And in the next part, I am going to show you exactly how to get a conventional loan, the gold standard of mortgages, with as little as 3% down. Yes, you heard that right. 3% down. This isn't some obscure, impossible-to-get grant or a lottery you have to win. This is the conventional 97 loan, and it is, without a doubt, one of the most powerful tools for a first-time homebuyer in America today. So let's pull back the curtain on the so-called gold standard of mortgages, the conventional loan. When you hear this term, it simply means a mortgage that is not backed or insured by the federal government. Instead, it's backed by 2 government-sponsored, but private corporations you may have heard of: Fannie Mae and Freddie Mac. These 2 giants are the bedrock of the American housing market. They don't lend money directly, but they buy mortgages from lenders, which frees up the lenders to make more loans. It's a huge stabilizing force. And because they set the rules for the loans they're willing to buy, they created special programs specifically designed to solve the biggest problem first-time buyers face: the down payment. The most popular of these are Fannie Mae's Conventional 97 and Freddie Mac's Home Possible and Home One programs. The 97 literally refers to the loan-to-value ratio, meaning you're borrowing 97% of the home's price and putting down just 3%. Let's make this real. Imagine a home you want to buy is listed for $400,000. The 20% down payment myth tells you that you need to walk into the bank with $80,000 in cash just to get your foot in the door. That is a monumental, soul-crushing number for most people. It can take a decade to save that much. But with a conventional 97 loan, that number plummets from $80,000 down to just $12,000. $12,000. That is a life-changing difference. That's the difference between dreaming of homeownership and actually achieving it, often years sooner than you ever thought possible. To qualify, at least one of the borrowers on the loan must be a first-time homebuyer. And the definition here is incredibly generous. A first-time homebuyer is anyone who hasn't owned a primary residence in the last 3 years. So if you owned a home in 2021 but sold it and have been renting since, you're back in the game. You are considered a first-time buyer again and can qualify for these programs. Now I know what you're thinking. Sounds too good to be true. There has to be a catch, right? And you're right, there is. But it's a catch that is far more manageable than you think. And it has a massive silver lining. The catch is called PMI, which stands for Private Mortgage Insurance. Because you're putting less than 20% down, the lender sees your loan as slightly riskier. If you were to default early on, they wouldn't have that big 20% equity cushion to protect their investment. So, to mitigate that risk, they require you to pay for an insurance policy. But here's the critical part. This insurance protects the lender, not you. It's the price you pay for the privilege of a low down payment. PMI is typically calculated as a percentage of your loan amount, paid monthly. It can range from about 0.3% to over 1.5% annually, depending heavily on your credit score and your down payment amount. A higher credit score means you're less of a risk, so you get a much lower PMI rate. For that $400,000 house with a 3% down payment of $12,000, your loan is $388,000. With a good credit score, your PMI might be around 0.6%. That works out to about $194 a month. So yes, your monthly payment is about $200 higher than it would be if you had put 20% down. But here is the multi-thousand-dollar secret that makes conventional loans so incredible. This PMI is not permanent. This is the single most important advantage. A conventional loan has over some other government-backed options we'll discuss later. Once your loan balance drops to 78% of the home's original purchase price, meaning you've built up 22% equity through your payments, the lender is legally required to automatically terminate your PMI. It just disappears from your monthly bill. Poof, gone. Even better, you can proactively request to have your PMI removed once you reach 80% loan to value. And if your home's value goes up significantly, you can often get it reappraised and use that new, higher value to show you have 20% equity, potentially getting rid of PMI years ahead of schedule. Think about that. You use the 3% down loan to get into the house. You live there for a few years making your payments, and the housing market in your area appreciates. Suddenly, that $400,000 home is worth $480,000. Your loan balance is now way below the 80% threshold of the new value. You make a phone call, maybe pay for an appraisal, and you could eliminate that $194 monthly PMI payment forever. This flexibility is the conventional loan's superpower. So, who is this loan perfect for? It's for the buyer with good to excellent credit. The minimum score to qualify is typically 620, but to get the best interest rates and the lowest PMI rates, you really want to be aiming for 700, and ideally 740 or higher. Every point matters. It's also for the buyer with a stable income and a reasonable amount of other debt. Lenders will look closely at your debt-to-income ratio, or DTI. This is a percentage that shows how much of your gross monthly income goes towards paying your monthly debts, things like car payments, student loans, and credit card payments. Generally, lenders want to see your total DTI, including your new proposed mortgage payment, stay at or below 43%. Some programs allow for a little more wiggle room, but keeping your other debts low is key. Another huge advantage of conventional loans, especially in a competitive market, is how they are perceived by sellers. When a seller sees you're pre-approved for a conventional loan versus some other types, they often see you as a stronger, more reliable buyer. Conventional loans tend to have a smoother, faster underwriting process and less stringent property appraisal requirements. In a bidding war with multiple offers on the table, having a conventional pre-approval letter can literally be the tiebreaker that gets you the house. It signals to the seller that your financing is solid and less likely to fall through over a small issue with the property. So let's recap the conventional 97. It's the gold standard. It allows you to buy a home with as little as 3% down. It has temporary, cancelable mortgage insurance that you can get rid of, saving you thousands over the life of the loan. It's viewed favorably by sellers, giving you a competitive edge. The main requirements are a decent credit score, the higher the better, and a manageable debt-to-income ratio. This loan single-handedly shatters the myth that you need a massive 20% down payment to enter the housing market. It rewards financial responsibility, a good credit score and low debt, with access to the most flexible and powerful mortgage product available. For many first-time buyers who have been diligently paying their bills and managing their credit, this is the key that unlocks the door to their first home. But what if your credit isn't perfect? What if you have a 610 credit score or even a 580? Does that mean you're locked out of homeownership forever? Absolutely not. There is another path. A loan designed by the government specifically to help people with less than perfect credit achieve the American dream. And it's the loan we're going to break down next. This loan is the FHA loan. And it might just be the most important, most impactful mortgage product in American history. It's the workhorse, the people's champion. It's backed by the Federal Housing Administration, and since the 1930s, it has helped millions of families who were told no by traditional banks, finally hear the word yes. Now let's clear up the biggest misconception right away. The FHA doesn't actually lend you the money. You still go to a regular bank or mortgage lender, but the FHA provides the lender with insurance. Think of it like this: the lender is nervous. They see your lower credit score or your small down payment, and they think, this is risky. The FHA steps in and tells the lender, hey, don't worry. If this borrower can't pay, we've got your back. We'll cover your losses. Suddenly, that risk disappears for the lender. And because they aren't scared anymore, they can relax their rules and approve people they otherwise would have rejected. That government insurance is the key that unlocks the door for you, the borrower. So what does this mean in practical terms? It means we can throw the old rulebook out the window. The first and most powerful advantage of an FHA loan is its credit score flexibility. Remember how we talked about conventional loans wanting a 620 score or higher? FHA loans blow that out of the water. With an FHA loan, you can potentially be approved with a credit score as low as 580 and still only need a 3.5% down payment. Let me say that again. A 580 credit score. That is a night and day difference. This is for the person who had a medical emergency that tanked their credit, the person who lost a job and missed a few payments, the young person who just hasn't had time to build a thick credit file. The FHA recognizes that a few financial mistakes in your past should not permanently disqualify you from building a stable future. If your score is even lower, between 500 and 579, it's still possible to get an FHA loan, but the down payment requirement jumps to 10%. But for the vast majority of people, that 580 score is the magic number that opens a door they thought was welded shut. The second massive benefit is that low down payment, 3.5%. Let's put that into real dollars. On a $300,000 home, a traditional 20% down payment is $60,000. That is a mountain of cash that can take a decade to save. A 3.5% down payment is just $10,500. Now that's still a lot of money, but it's an achievable goal. It's within reach, and it gets even better. The FHA is incredibly generous when it comes to where that down payment money comes from. The entire 3.5% can be a gift. From your parents, your grandparents, a sibling, even your employer or a charitable organization. Imagine your parents offering to help you with the down payment. With a conventional loan, there are sometimes complex rules about seasoning the funds or how much can be gifted. With an FHA loan, it's straightforward. As long as the gift is properly documented with a gift letter stating it's not a loan that needs to be repaid, you are good to go. This single feature has turned the dream of homeownership into a reality for countless young buyers who have family ready and willing to help. The third advantage is a bit more technical, but it's a lifesaver for many. FHA loans allow for a higher debt-to-income ratio, or DTI. Your DTI is simply the percentage of your gross monthly income that goes towards paying your monthly debts, things like student loans, car payments, and credit card minimums. Conventional loans are often very strict, typically capping your DTI around 43%, maybe 45% in some cases. But FHA loans can often stretch to 50%, or even higher in some circumstances with compensating factors. This means if you have significant student loan debt or a hefty car payment, an FHA loan might be the only way you can get approved for a mortgage right now. Okay, lower credit scores, a tiny down payment that can be gifted, and more forgiving debt rules. The FHA loan sounds perfect, right? Sounds like there's no catch. But there is one, and it's a big one. You need to understand this part because it's the trade-off you make for all that flexibility. The catch is called mortgage insurance premium, or MIP. Because the FHA is insuring the lender against risk, you, the borrower, have to pay for that insurance. And it comes in two parts. First, there's the upfront mortgage insurance premium. This is a one-time charge of 1.75% of your total loan amount. So on a $300,000 loan, that's an extra $5,250. Now, you don't usually pay this out of pocket. It's almost always rolled into your total mortgage balance, so you pay it off over time. But the second part is the one that really stings. It's the annual mortgage insurance premium. Despite its name, it's paid monthly as part of your mortgage payment. And here is the critical difference. With a conventional loan, your private mortgage insurance, or PMI, automatically falls off once you have about 22% equity in your home. With an FHA loan, if you put down less than 10%, which most people do, that monthly MIP payment lasts for the entire life of the loan. For all 30 years. It never goes away on its own. That can add thousands, even tens of thousands of dollars in extra cost over the decades. There are a couple of other things to be aware of. FHA loans have stricter property standards. An FHA appraiser doesn't just determine the home's value. They perform a basic safety inspection. They're looking for things like peeling paint in older homes, which could be a lead paint hazard. They check for a solid roof, functioning utilities, and basic safety features. This is good because it protects you from buying a lemon, but it also means that cool fixer-upper you wanted to buy might not pass the FHA appraisal, which can be a deal killer. Finally, FHA has loan limits that vary by county. In most of the country, the limits are plenty high, but if you live in a super high-cost area like San Diego or Boston, the FHA loan limit might not be enough to buy the home you want. So with this forever mortgage insurance, is the FHA loan a bad deal? A trap? Absolutely not. You just have to use it strategically. You have to see the FHA loan not as your forever loan, but as your get-in-the-game loan. Think of it as a stepping stone. Here's the strategy, the FHA Wealth Building Playbook. Step 1. You use the FHA loan to buy your first home right now with your current credit and savings. You get out of the rent race and start building your own equity. Step 2. You live in the home for a few years. You make every single mortgage payment on time, which helps rebuild and strengthen your credit score. At the same time, the real estate market does its thing, and your home's value hopefully appreciates. Step 3. Once you've paid down the loan a bit and the value has gone up, you'll eventually reach 20% equity. Your credit score is now much higher. This is the moment you execute the final play. You refinance. You get a brand new loan, this time a conventional loan, to pay off your old FHA loan. And just like that, the FHA mortgage insurance is gone. Forever. You've successfully used the FHA loan as a temporary tool, a bridge to get you from renting to sustainable homeownership. You took advantage of its easy entry requirements, and then you shed its long-term costs as soon as you were in a stronger financial position. This is the smart way to use an FHA loan. So, who is this loan perfect for? It's for the person with a credit score that's good but not great. It's for the person who's a diligent saver, but doesn't have a massive nest egg for a down payment. It's for the recent graduate with a good job but a lot of student debt. It's for anyone who is tired of waiting on the sidelines and is ready to get in the game, using a powerful government-backed tool designed to give them that exact chance. The FHA loan is the great equalizer. But what if you belong to a very specific group of Americans? A group that has served our country and earned a benefit that is, without a doubt, the single greatest mortgage product in existence. What if I told you there's a loan with no down payment required, not 3.5% but 0, and no monthly mortgage insurance at all? It exists, and it's what we're diving into next. This loan is called the VA loan, and it's guaranteed by the U.S. Department of Veterans Affairs. Now before you think, I'm not a veteran, this isn't for me, just hang on. Understanding how this loan works provides a powerful benchmark for what a truly phenomenal mortgage looks like. And for those of you who have served, or have a spouse who has, this could be the single most important financial information you hear all year. Let's break down the two earth-shattering benefits we just mentioned. First, zero down payment. Not 3%, not 5%. Zero. On a $400,000 home, a conventional loan might require $12,000 to $20,000 down. An FHA loan would require $14,000. With a VA loan, the minimum required down payment is $0.00. This single feature catapults veterans into homeownership years, sometimes even a decade, before they could have otherwise saved up the necessary cash. It completely changes the timeline of their lives. Second, and this is almost as powerful, there is no monthly private mortgage insurance or PMI. As we discussed, PMI is that pesky extra fee you pay every month on conventional and FHA loans when you put down less than 20%. It's insurance that protects the lender, not you, but you're the one paying for it. On that same $400,000 FHA loan, you could be paying an extra $250 to $300 a month for years, money that vanishes into thin air and builds you zero equity. With a VA loan, that $300 a month stays right in your pocket. Over 5 years, that's $18,000 in savings. Over the life of the loan, it could be tens of thousands. When you combine a $0 down payment with $0 in monthly mortgage insurance, the financial advantage is staggering. It's not just a good deal. It's a fundamental restructuring of how you buy a home. So, who is this incredible loan for? The VA loan is an earned benefit for those who have served or are currently serving in the U.S. military. This includes active duty personnel, veterans, members of the National Guard and Reserves, and in some cases surviving spouses. To get the loan, you need what's called a Certificate of Eligibility, or COE. Don't let the official sounding name intimidate you. This is a simple document that proves to the lender you have the required service history. Any good lender who specializes in VA loans can pull this for you in minutes, often with just your social security number and date of birth. Generally, the service requirements are about 90 consecutive days on active duty during wartime, or 181 days during peacetime. For Guard and Reserve members, it's typically 6 years of honorable service. There are nuances, of course, but the key takeaway is that millions of Americans are eligible for this benefit and many don't even realize it. They served their country, earned this incredible advantage, and are still trying to save up for an FHA loan, leaving thousands of dollars on the table. Now, there are a couple of persistent myths about VA loans I want to shatter right now. The first is that they are slow and filled with government red tape. This might have been true 30 years ago, but today it's completely false. With a competent lender, a VA loan can close just as quickly as any other loan type. The process is streamlined and digitized. The second myth is that sellers don't like accepting offers from buyers using a VA loan. This myth stems from the VA's appraisal process, which is admittedly strict. They have a set of standards called the Minimum Property Requirements, or MPRs, to ensure the home is safe, sound, and sanitary. But think about what that means. It means an expert is making sure the veteran isn't buying a home with a leaky roof, a faulty electrical system, or a crumbling foundation. The appraisal is there to protect the veteran. A smart seller and a smart agent know that a VA-backed buyer is one of the most financially secure buyers in the market because their loan is guaranteed by the U.S. government. Okay, a zero down, no PMI loan sounds too good to be true. So what's the catch? There is one, but it's a very manageable one: the VA funding fee. This is a one-time fee paid directly to the Department of Veterans Affairs, which is used to help fund the program and keep it running for future generations at no cost to taxpayers. The amount of the fee is a percentage of the loan amount and it varies. For a first-time user putting zero down, it's typically 2.15%. So on that $400,000 loan, the funding fee would be $8,600. Now, before your heart sinks, here's the most important part. You almost never pay this fee out of pocket. In nearly all cases, the VA funding fee is simply rolled into your total loan amount. So your loan becomes $408,600. Your monthly payment goes up by a small amount, maybe $40 or $50, but you still get into the house with zero cash down. When you compare that $50 a month to the $300 a month you'd be paying in mortgage insurance on an FHA loan, it's not even a contest. You're still saving hundreds every single month. And here's the final incredible kicker. Veterans who receive compensation for a service-connected disability are completely exempt from the VA funding fee. They don't pay it. For these veterans, the loan becomes a true zero down, zero PMI, zero funding fee mortgage. It is, without exaggeration, the best home loan that has ever existed in the United States. Let's make this real. Imagine a veteran named Michael. He finished his 4 years of service and now works as a technician. He makes a decent living but has student loans and car payments. Saving $20,000 for a down payment feels impossible. He thinks he's 5 years away from even thinking about buying a home. Then a friend tells him about the VA loan. He calls a lender, who confirms his eligibility and gets him pre-approved in a day. 2 weeks later, he finds a perfect starter home for $300,000. His offer is accepted. His down payment? Zero. His closing costs are minimal because the VA limits what lenders can charge. He has a VA funding fee of about $6,400, which he rolls right into the loan. His total loan amount is $306,400. $450. His monthly mortgage insurance? Zero. His friend, who is not a veteran, bought a similar house a year earlier using an FHA loan. His friend had to bring over $10,000 to closing, and now pays an extra $190 every single month for mortgage insurance. Michael, on the other hand, is building a future for his family, gaining equity, and saving nearly $2,000 a year, all because he used the benefit he rightfully earned. That is the power of the VA loan. It's not just a mortgage product, it's a life-changing tool. So if you have ever worn the uniform of the United States military, this is your benefit. It is a thank you from a grateful nation, delivered in the most practical way possible. A path to a home of your own. But what if you haven't served? What if you look at the zero down payment feature of the VA loan with envy, thinking that's exactly what you need to get out of your apartment and into a home? Is there anything out there for you? What if I told you there's another government-backed loan, available to the general public, that also requires zero money down? It's not for everyone, and it has a very specific requirement, but for millions of Americans, it's the key that unlocks the door to homeownership. I'm talking about the USDA loan. And before you click away thinking you have to be a farmer to get one, let me stop you right there. This is probably the single most misunderstood home loan in America, and that misunderstanding is costing millions of people the chance to own a home. The USDA loan program, officially called the Single Family Housing Guaranteed Loan Program, has almost nothing to do with farming. It's a rural development loan. Its entire purpose is to encourage people to build vibrant communities in less populated areas of the country. And the government does this by offering a loan so good, it almost sounds fake. 100% financing. Zero down payment. So what's the catch? The big one, the non-negotiable one, is location. The property you want to buy must be located in an eligible rural area, as defined by the U.S. Department of Agriculture. Now, your brain might immediately picture a farmhouse in the middle of a cornfield miles from civilization. And yes, that would qualify. But the USDA's definition of rural is incredibly broad. It includes huge swaths of suburban America. It includes small towns, communities with populations under 35,000, and even the outskirts of major metropolitan areas. You would be absolutely shocked to see the maps. There are eligible properties just a 30-minute drive from major city centers all across the country. The only way to know for sure is to check. The USDA has an official eligibility map on their website. You can literally type in an address and it will tell you instantly yes or no. This 5-second check could be the difference between you renting for another decade and you holding the keys to your own home next year. But let's assume you find a home you love in an eligible area. What makes this loan so powerful beyond the zero down payment? First, the interest rates. Because these loans are guaranteed by the government, lenders see them as very low risk. That low risk translates into lower interest rates for you, the borrower. Often USDA loan rates are among the lowest available on the market, period. Over 30 years, a slightly lower interest rate doesn't just save you a little money, it saves you tens of thousands of dollars. Second, let's talk about mortgage insurance. Like the FHA loan, because you're not putting down 20%, you have to pay for mortgage insurance. But the way the USDA handles it is a game changer. Instead of a high monthly premium like FHA, the USDA has two parts. There's an upfront guarantee fee, which is usually around 1% of the loan amount, and this fee is almost always rolled right into your total loan balance, so you don't pay it out of pocket. Then there's a small annual fee paid monthly. And when I say small, I mean it. The annual fee is currently just 0.35% of the loan balance. Let's put that into real numbers. On a $300,000 loan, the FHA's monthly mortgage insurance premium would be around $140 a month for the life of the loan. The USDA's monthly fee for that same loan amount? It would be about $87. That's a savings of over $50 every single month, or $600 a year. Over the life of the loan, that's a massive difference. And unlike conventional loans, your credit score doesn't impact the cost of this mortgage insurance. Everyone gets the same low rate. So we have zero down payment, lower interest rates, and dramatically cheaper mortgage insurance. Sounds incredible, but who is this actually for? This is the other major requirement. Income limits. The USDA loan is designed for low to moderate income households. This means you can't make too much money. The income limits vary wildly depending on what county you live in and how many people are in your household. In a lower cost of living area, the limit for a family of 4 might be around $100,000 a year, but in a higher cost area, it could be significantly more. Again, the USDA has a simple tool on their website where you can select your state and county and see the exact income limit for your family size. It's designed to help working-class families, the very people who have a steady job but struggle to save up that massive lump sum for a down payment. As for credit, there's no official minimum score set by the USDA, but in the real world, most lenders will want to see a credit score of at least 640. A higher score will, of course, make the process smoother and help you secure the absolute best interest rate. The property itself also has to meet certain basic health and safety standards, but these are very reasonable and similar to FHA requirements. And remember, this loan is only for your primary residence. You have to intend to live in the home. No vacation homes or rental properties allowed. Let me tell you about a couple I know. Let's call them Jenna and Mark. Jenna's a dental hygienist, and Mark works for the local school district. They had good credit, stable jobs, but with student loans and the rising cost of living, saving for a down payment felt impossible. They were looking at homes in the suburbs of their city, but everything required at least $10,000 to $15,000 down plus closing costs. They were completely discouraged. A friend mentioned the USDA loan and they laughed, saying, "We don't want to live on a farm." But their friend insisted they just look at the map. So they did. And they were stunned. The charming small town just 25 minutes outside the city, a place they loved visiting on weekends, was entirely within an eligible zone. They found a lender who specialized in USDA loans, got pre-approved, and a month later, they found a beautiful 3-bedroom home, perfect for their future family. They went from contract to closing in 45 days and walked into their new home with zero money down. Their total cash to close was just for the appraisal and some closing costs, which was a fraction of what they would have needed for any other loan. Their mortgage payment, thanks to the low interest rate and tiny mortgage insurance fee, was less than what they were paying in rent for a smaller apartment. For them, the USDA loan wasn't just a financial product. It was the key that unlocked a future they didn't think was possible for at least another 5 years. Now, it's not perfect. The geographic restriction is the biggest hurdle. If your job and your life are planted firmly in the heart of a major city, this loan isn't for you. The income cap is the second hurdle. If you're a high-income earner, you won't qualify. And because it's a government program, the underwriting process can sometimes take a little longer than a conventional loan, as it has to be approved by both your lender and then by the USDA itself. But for the millions of Americans who fit the criteria, who are looking for a life in a smaller town or a quieter suburb, the USDA loan is, without a doubt, one of the most powerful home buying tools in existence. It's a direct path to homeownership for those who have the income to support a mortgage payment, but not the massive pile of cash for a down payment. So we've covered the heavy hitters from the government: FHA for flexibility, VA for our veterans, and USDA for rural communities. These programs have helped millions achieve the American dream. But what if you don't qualify for any of them? What if you have a great credit score and you've saved up a small down payment, say 3 or 5%, but you want to avoid the fees and restrictions that can come with government-backed financing? Well, the private market has an answer for you. And for the right person, it might just be the most powerful and cost-effective option of all. This brings us to our number 4 loan, the secret weapon for first-time buyers with good credit but low savings. It's called the conventional 97. The name itself tells you the most important part. You finance 97% of the home's value, meaning you only need a 3% down payment. This is the private market's direct answer to the FHA loan, and it's offered through programs backed by the 2 giants of the mortgage world, Fannie Mae and Freddie Mac. You'll hear their program names thrown around: Home Ready from Fannie Mae and Home Possible from Freddie Mac. But just think of them as 2 flavors of the same powerful idea: a conventional loan with a tiny down payment. Now you might be thinking, okay, 3% down sounds great, but what's the catch? And how is this any different from the FHA's 3.5%? The difference isn't just that 0.5%. The difference is a single 4-letter acronym that could save you tens of thousands of dollars over the life of your loan. PMI. Private Mortgage Insurance. And understanding how it works is the key to unlocking massive savings. With an FHA loan, you pay a mortgage insurance premium, or MIP. As we discussed, it has 2 parts: an upfront fee and a monthly premium that, for most people, lasts for the entire life of the loan. It never goes away. It's like a permanent house guest who eats your food and never helps with the bills. PMI, on the other hand, is the house guest who knows when it's time to leave. It's temporary. This is the single biggest advantage of a conventional 97 loan. Here's how it works. Private mortgage insurance also protects the lender in case you default, just like FHA's MIP. But with a conventional loan, once you reach 20% equity in your home, meaning your loan balance is 80% of the home's original value, you can formally request to have your PMI canceled. The lender is then legally required to terminate it. Even better, by law, the lender must automatically terminate your PMI once your loan balance is scheduled to reach 78% of the original value. Let's put that into real numbers. Let's say you buy a $400,000 home. Your monthly PMI payment might be $250. With an FHA loan, you're paying a similar fee, let's say $275 every single month for 30 years. That adds up to $99,000 in mortgage insurance payments. But with the conventional 97, you pay that $250 a month for, say, 7 or 8 years. Once you hit that 20% equity mark through a combination of your monthly payments and home appreciation, you call your lender, get a new appraisal if needed, and poof, that $250 charge vanishes from your monthly statement. Forever. You've just given yourself a $250 a month raise. The savings compared to the FHA loan aren't just a few bucks. They're life-changing. We're talking about over $75,000 in this example. That's a new car, a college fund, a complete kitchen renovation. All because you chose a loan with an exit strategy for its insurance. But the good news doesn't stop there. The cost of PMI is also different. FHA's MIP is a one-size-fits-all rate. It doesn't matter if your credit score is a 640 or a 780. You pay the same percentage. PMI, however, is risk-based. It's tailored to you. Lenders look at your credit score, your down payment amount, and your debt-to-income ratio to determine your PMI rate. This means if you have a strong credit profile, you will be rewarded with a significantly cheaper monthly PMI payment than what you'd pay for FHA's MIP. For someone with a 760 credit score, their PMI on a conventional 97 could be half the cost of the MIP on an FHA loan for the exact same house. So not only does it go away eventually, but it's also cheaper while you have it. So, who is the perfect candidate for a conventional 97 loan? It's someone who checks a few specific boxes. First, and most importantly, you have a good to excellent credit score. The absolute minimum is typically 620, but to really unlock the benefits of low-cost PMI, you want to be north of 700, ideally 720 or higher. Second, you have your financial house in order with a relatively low debt-to-income ratio. Conventional loans are less forgiving than FHA loans in this area. They want to see that your proposed new housing payment plus your other monthly debts, like car payments and credit cards, don't take up too much of your gross monthly income. Third, you have savings for a down payment, just not a massive amount. You've got the 3% plus closing costs, but coming up with 10 or 20% is out of reach right now. And finally, you might be looking at a home that's in good shape but isn't perfect. Conventional appraisals are generally less strict than FHA appraisals, which are notorious for flagging minor issues like peeling paint or a worn-out railing. This gives you a wider selection of homes to choose from. Now, for the sake of total transparency, let's talk about the potential downsides, or the gotchas. The biggest one, as we've said, is the credit score requirement. If your credit history is bruised or you're still building it, the FHA loan is going to be a much more accessible path. The second potential hurdle is income limits. This is critical to understand, because the Home Ready and Home Possible programs are designed to help low to moderate income families. They often have income caps. This means that in many areas, if you earn above a certain amount, you won't be eligible for these specific 3% down programs. The limits vary dramatically based on your county, so it's absolutely essential to look up the income limits for your specific area on the Fannie Mae or Freddie Mac websites. Don't assume you qualify or don't qualify, you have to check. For some high cost of living areas, these low to moderate income limits can actually be surprisingly high. Lastly, most lenders will require you to complete a homebuyer education course to qualify. This usually costs a small fee and takes a few hours online. Honestly, I don't even see this as a downside. It's a fantastic way to learn the ins and outs of the biggest financial decision of your life. And it's a small price to pay for a loan that can save you so much money. So, let's recap the conventional 97. It offers the low 3% down payment of a government loan, but with the powerful money-saving features of a conventional product. Its main feature, the temporary and often cheaper private mortgage insurance, makes it a financial grand slam for buyers with strong credit. You get into a home with minimal cash out of pocket, and you have a clear, predictable path to lowering your monthly payment in the future. It offers more flexibility on property condition, and rewards your years of financial responsibility. For the right person, it's not just a good option. It's the smartest option on the board. We've now covered the big four: the accessible FHA, the unbeatable VA for veterans, the niche USDA for rural areas, and the powerful conventional 97 for those with great credit. These four loans cover probably 95% of all first-time homebuyers. But what about the other 5%? What if you don't fit neatly into any of these boxes? What if you're a recent medical school graduate with a six-figure job offer, but a mountain of student debt that disqualifies you from a traditional mortgage? Or what if you're a successful freelance artist or small business owner whose income looks amazing on bank statements, but not so great on tax returns after all the write-offs? For these unique situations, the standard rulebook gets thrown out the window. There's a fifth category of loans, a set of specialized tools for specialized buyers. In our final segment, we're pulling back the curtain on these portfolio or niche loans, the secret keys that can unlock homeownership when every other door seems closed. These loans are the master keys of the mortgage world, held not by the giant, faceless corporations, but by the lenders themselves. They're called portfolio loans because the bank or lender keeps the loan in their own investment portfolio, instead of selling it off to big investors like Fannie Mae or Freddie Mac. And because they're keeping it, they get to make their own rules. This is where the game changes. This is the world of non-qualified mortgages, or non-QM. If a qualified mortgage is a loan that fits neatly inside the government's perfect little box, a non-QM loan is for everyone who lives outside of it. It's for the innovators, the entrepreneurs, the resilient, the people whose financial stories are written in more than just a W-2 and a credit score. Let's meet our first specialist, the bank statement loan. This is the holy grail for the self-employed. Think about the freelance graphic designer pulling in $150,000 a year, or the successful YouTuber, or the consultant who runs their own business. On paper, their income can look deceptively low. Why? Because they're smart. They take every legal tax deduction and write-off they can: home office, equipment, travel, software. Their tax return might show an income of only $60,000. When they walk into a traditional bank asking for a conventional loan, the underwriter looks at that $60,000 number and denies them for a $400,000 house, even though their bank accounts show a steady, massive cash flow month after month. It's a frustrating brick wall experience for millions of American entrepreneurs. The bank statement loan smashes right through that wall. Instead of tax returns, these lenders look at what actually matters: your real cash flow. They'll ask for 12 or 24 months of personal or business bank statements. They'll analyze your deposits to verify your actual income, the money you live on, the money you'll use to pay the mortgage. It's a common-sense approach to lending that acknowledges the reality of the modern economy. For the gig worker, the freelancer, the small business owner, this isn't just a loan, it's validation. It's a lender finally seeing your success for what it truly is. Next, let's talk about a loan that embodies the American dream for those who are building a new life here: the ITIN loan. Millions of people in the United States work hard, pay their taxes, and contribute to their communities, but they don't have a social security number. They have an ITIN, an individual taxpayer identification number, issued by the IRS for tax purposes. For years, this was a hard stop for homeownership. No social security number, no loan. Period. But portfolio lenders saw an opportunity to serve a massive and deserving community. An ITIN loan allows a non-permanent resident alien to purchase a home using their ITIN instead of a social security number. The requirements are often stricter. You might need a larger down payment, say 15 or 20%, and the interest rate might be a bit higher. But the door is no longer closed. It's a pathway to building wealth and stability for families who are putting down roots in this country. It allows a skilled contractor or a talented chef who pays their taxes diligently to own a piece of the community they help build every single day. This is a life-changing financial tool that recognizes that a person's value and creditworthiness isn't defined by a 9-digit number, but by their hard work and financial discipline. Finally, there's a category of niche loans that I call second chance loans. Life happens. A medical emergency, a business failure, a divorce. Any one of these can lead to a devastating financial event like a bankruptcy or a foreclosure. The standard lending world is unforgiving. An FHA loan might make you wait 2 years after a bankruptcy. A conventional loan could make you wait up to 7 years after a foreclosure. It can feel like a life sentence, preventing you from rebuilding even when you're back on your feet, with a great job and a healthy savings account. This is where a portfolio lender can step in. They offer loans specifically for people who have had a recent major credit event. They don't just look at the FICO score, They look at the story. They practice what's called manual underwriting, where a human being, not just an algorithm, reviews your entire file. They want to see what happened, why it happened, and what you've done to recover since. If you can show that the event was a one-time catastrophe, and you've been a model of financial responsibility ever since, they can often approve a loan just one day after the event is finalized. One day, the interest rate will be higher, absolutely. You're a higher risk and the rate reflects that. But the plan is simple. You get into the house, you spend a year or two making every payment on time, you rebuild your credit, and then you refinance into a better, lower-rate conventional loan. It's not a forever loan, it's a bridge. It's a bridge back to normalcy, a bridge back to homeownership, a bridge that says a past mistake doesn't have to define your future. So where do you find these magical loans? You won't see them advertised during the Super Bowl. You typically won't find them at the giant national bank on the corner. Your best bet is to work with an independent mortgage broker. Brokers don't work for one bank. They have relationships with dozens, sometimes hundreds of lenders, including these specialized portfolio lenders. They are the matchmakers of the mortgage world. You tell them your unique story, and they know which niche lender to call. Small local community banks and credit unions are also fantastic places to look. They often keep their loans in-house and have the flexibility to serve the specific needs of their local community. And with that, we've come to the end of our journey. We've covered the 5 major pillars of first-time homebuyer financing in 2026. We started with the FHA loan, the accessible starter home of mortgages, perfect for those with lower credit and a smaller down payment. We moved to the conventional loan, the gold standard, the reward for excellent credit and solid savings. We honored our service members with the VA loan, a zero down payment benefit earned through sacrifice. We explored the countryside with the USDA loan, another zero down option for making a home in rural America. And just now we unlocked the secret level. The portfolio and niche loans, the specialist tools for the entrepreneurs, the new arrivals, and the comeback kids. The single most important thing I want you to take away from this entire series is this. There is no such thing as the best loan. There is only the best loan for you, for your finances, for your family, for your story. The goal of these 10 parts was not to give you a simple answer, but to give you something far more valuable: knowledge. The power to walk into a lender's office not with fear and confusion, but with confidence and a strategy. You now understand the language of lending. You know the questions to ask. You know that if one door closes, there are 4 other doors and maybe even a few secret passages to try. You are now more prepared than 95% of the people out there trying to buy their first home. Your journey to homeownership doesn't end with this video. It begins. Take this knowledge, find a great real estate agent, talk to a mortgage broker, and start building your plan. The American dream of homeownership is not a myth. It's not a relic of a bygone era. It is real, it is achievable, and it is waiting for you. To continue on this path with us, and to get more insights that will save you time, money, and stress, make sure you subscribe to the channel and turn on notifications. Every video we make is designed to give you an unfair advantage in your financial life. And please think of one person you know, a friend, a family member, a coworker, who is dreaming of their first home but feels lost. Share this video with them. Be the person who hands them the map. Thank you for investing your time with us. The keys to your future home are now in your hand. Go open the door.